You were taught a story about wealth, that the families at the top of the financial pyramid, the Rothschilds, the Medicis, the Rockefellers, outworked everyone else.
Built the architecture that dictates how your money moves before you even earn it. The rules of the American dream are clear. Secure a salary, buy a home to build equity, and save in a 401k. It's presented as the only logical path to security. The system utilizes the hedonic treadmill. As income rises, you upgrade via debt, keeping net worth at zero while banks profit. Clinically, this debt cycle triggers depressive disorder in adults under 40. You're running on a floor designed to sink. The exhaustion felt by the middle class isn't a personal failure. It is the intended output of an extraction machine that has been refined by banking dynasties for over 600 years. The Medici family laid the first stones of this architecture in the 1400s. The Catholic Church had strictly banned usury, charging interest on a loan. To bypass this, the Medici rebranded interest as exchange fees for converting currencies between cities. This simple change in language allowed them to fund the papacy itself, eventually paying for the Sistine Chapel ceiling with profit that was technically forbidden. This same rebrand governs your life today. When you take out a 30-year mortgage, the bank uses fractional reserve lending. They don't lend you money saved by other depositors. They type the amount into a ledger, creating it digitally the moment you sign the contract. This chart shows the math of a typical $400,000 home loan at current rates. The blue block is what you borrowed. The red block is the $558,000 in pure interest you will hand to the bank. You are paying over $500,000 for the bank's ability to type a number into a computer. The 401k system operates on this same structural extraction. While you save, asset managers siphon off wealth through compounded fees. A 1% annual fee may sound trivial, but over 30 years, it can cost a median saver approximately $170,000 in lost growth. The names change, from exchange fees to mortgages to expense ratios, but the underlying geometry remains. The institution's profit is guaranteed and front-loaded, while the consumer takes the long-term risk. John D. Rockefeller understood a different principle. Control the infrastructure, and you own everything that moves through it. Standard Oil didn't just refine oil. They secured secret rebates from the railroads. This created a lethal toll road for his competitors, who were forced to pay higher shipping rates than Rockefeller. He didn't have to beat them in the marketplace. He just had to own the path to get there. Today, firms like BlackRock and Vanguard have moved the choke point. They are now the largest shareholders in nearly 90% of the S&P 500. They hold dominant stakes in competing airlines, competing banks, and competing energy companies simultaneously. This reaches a peak with BlackRock's Aladdin algorithm, a private system that manages risk analytics for $21 trillion in global assets. One platform now influences the positioning of more capital than the GDP of almost every nation on Earth. When Standard Oil was broken up in 1911, the resulting companies became collectively more valuable than the original monopoly. Antitrust actions rarely end the capture. They often just drive the predators to upgrade their infrastructure from physical pipelines to invisible algorithms. In 1815, Nathan Rothschild used a private courier network to learn about Napoleon's defeat at Waterloo a full day before the British government. He used that 24-hour head start to trigger a market panic, selling his holdings to drive prices down before buying back the entire market at a fraction of its value. He multiplied his capital 20-fold because he knew the truth before the public did. Today, that speed advantage is found in the thousands of pages of SEC filings and Federal Reserve transcripts that the average person never reads. The data is public, but the asymmetry exists because the 1% react to primary sources, while the public waits for a headline. This is the center of that asymmetry. The Federal Reserve makes decisions that shift trillions of dollars in value, but the official minutes aren't released until weeks later. By the time you feel the impact on your savings, the institutional capital has already moved. The edge isn't just knowing more, it's knowing it first. Today, the machine relies on the fact that most people will never look at the original ledger. You cannot opt out of this system. Participation is the baseline, but you can change your position within it. You have to stop acting like prey. First, prioritize liquidity over illiquid assets. The median American keeps 70% of their net worth in home equity, an immovable block that generates no cash flow and costs money to maintain. The 1% alternative is to keep capital mobile, allowing you to move when the market shifts, rather than being anchored to a single debt. Second, own a node, not a position. A salary is a position inside someone else's infrastructure. It has no leverage. A node is a choke point. A proprietary machine can't run without. We've seen the evolution, from Medici exchange fees to Rothschilds couriers, from Rockefellers pipelines to BlackRock's algorithms. The scale has increased, but the extraction is the same. This brings us to a final question. When a few private entities own the infrastructure, the data, and the dominant stakes in every competing industry, at what point does this stop being capitalism and become something else? Tell me what you think that something else is in the comments. Subscribe to see our next breakdown on how the Federal Reserve's interest decisions specifically shift wealth from your paycheck to asset holders. Stay liquid.